Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are here at the Metals Investor Forum with Garrett Goggin of the Golden Portfolio. Garrett, thank you for coming on the show.
Thank you.
Yes. Okay, so this is your first time on the show. Go ahead and give listeners a little elevator pitch of who you are and how that led to the portfolio that you have today.
Garrett Goggin. I'm from Boston originally. CFA, MBA. I'm a CMT. I do the technical stuff as well. But, the traditional Boston financial community is very conservative. Worked in the mutual fund industry at Putnam where you invest for the long term and everything will be fine. But, I was, wondered about, commodities and what happens when the cycle runs out and the money runs out and the debt gets too high. And, it led me into the gold sector. Got my MBA and started working with John Duty, the gold stock analyst 15 years ago, then with Stansberry Research as an analyst for another 5 years. So I've been in the industry for, over 15 years. And that led me into, the precious metal sector. And I've been able to apply my, financial modeling skills to the precious metal sector in order to find, undervalued investments.
Okay. All right. What is your macro view of the gold market today?
Yeah. We can go many ways regarding this. One of the things that's interesting is you get gold at $2,700 an ounce. It's making new highs in every single currency around the world. People look at it and they're like, oh, look at gold. It's so high. It's making new highs. Yeah. But then a couple things. If you look at the valuation of the miners, the average large cap miner trades at 6.4 times free cash flow. It's like this is the lowest multiple all the way back to 2015. So you have gold at an all-time high. You have the miners trading at the lowest multiple to free cash that they have. It's one of the biggest opportunities that, I've ever seen because no one is expecting 3,000, 4,000, 5,000. Like no one is expecting it. And the handwriting is on the wall. There's so many smoke signals that are occurring in the economy right now with the Trump administration. Treasury Secretary Scott Bessent, his largest holding is gold. It's his biggest position in his portfolio. Trump is a big fan of Judy Shelton. Tried to get her on the Fed last time. He might be able to now. She is a big gold bug. She is proposing that the Treasury issue gold-backed 50-year Treasury bonds on July 4th, like in a year from now. There's smoke signals within Europe where the European community is backing 4% of their GDP by gold. And if you look at the amount of gold that they hold, it comes out to roughly about 4%. You got the BRICS nations. China's been stockpiling tremendous amounts of gold. They own a low percentage of gold to GDP, and they have been actively adding a tremendous amount of gold over the past couple of years. You have Enbridge, right? Yeah. The UAE and China getting together with a digital currency that could perhaps be backed by gold, who knows? But bottom line, deep pocket institutions and central banks around the world are buying gold hand over fist. There isn't enough to go around. You look at the U.S. debt at $37 trillion. It's ridiculous. Now, some people are worried about Trump. I'm not worried about Trump. I think Trump's going to be great for the economy, great for the market, great for gold, because Trump watches the stock market. He watches the stock market like 24 hours a day. The stock market is a real-time representation of how he's doing as a president. He's a businessman, and he's obviously obsessed with it. He's not going to let the stock market go down. But what he needs in order to make the stock market to keep going up, he needs lower rates. He's actively said that. He's like, we need lower rates. Scott Bessent they need to issue a lot of longer term debt here. And, with the Fed starting cutting rates, the yield started increasing. The yield needs to go down. And then the other thing that Trump needs is a weaker dollar. The dollar has had a good run here against other currencies. And Trump needs that to start going down to improve the trade balance and, all the business activity. But if you look at when Trump was in president over his last term, the debt outstanding rose by $8 trillion.
Yeah.
The stock market went up by like 40%. The dollar went down by like 15%, and gold went up, I think, like 30% over his last term. So everyone's, going crazy about all this stuff that's going on. But just look at his last term. He's going to do whatever it can to push the stock market higher. But the thing is, when there's inflation in the economy, even significant inflation, stocks generally do pretty well, right? Because their revenue increases, their profits increase on a per share basis. So the stock market continues higher with inflation, and that's like the secret. The Federal Reserve, the Federal Reserve, are they there to keep the price of inflation low and mandates 2%, or are they there to continuously pump that bubble up? And that's what that we're going to see with the Trump administration. And then the last thing, in order for Trump to get low rates, in order for Bissett to be able to issue a tremendous amount of debt to fund the U.S. government, I believe that we're going to get a QE5 coming up very soon, and it's going to be yield curve control, where the Fed's going to be actively buying Treasury debt in order to manage rates lower, right? And then Scott Bessent has the Treasury Secretary has expressed his he wants a shadow Fed governor to represent the Treasury on the Federal Reserve Board. So I think we're going to see like a monumental shift where the Treasury and the Fed are going to work together in order to manage the debt load, in order to keep rates low. But this is going to set a fire under gold, because this is monetary debasement.
Yeah.
You look at the Dixie and it's versus other currencies, but that you need to look at gold. Gold is the canary in the coal mine, right, for monetary devaluation. And that's what gold is signaling now.
That's the real value of the dollar, not the DM.
Exactly. So I think we're shaping up for a big run. I believe we're shaping up for a monumental shift in monetary policy, and we're going to see stuff that we'll never see before in the past few years.
Okay, so past his prologue, if you look at Trump's last presidency, gold did pretty well. All right, the dollar got weaker. The stock market did well. You're saying that he's got a vested interest in making the dollar a little bit weaker. That'll prop up the stock market, but that will also, if the dollar's weaker, it takes more of those dollars to buy the same barrel of oil or the same ounce of gold. So gold should also do well.
Yep, exactly.
Okay, all right. So now macro view on silver. So gold is money, silver is also money, but we got a lot more speculation in there. What do you see macro view for silver?
Yeah. Gold is used for investment purposes. Central banks are buying tons and tons of it. Silver is more of a industrial metal. There's major fundamental drivers for silver, whereas gold is only investment demand. Silver is used to manufacture all of our technology. It's in our cell phones. They use to make TVs. They use to make all electronics, and what they use silver for is the solder that connects the wiring and all those parts. You get the EV industry with the batteries. As Samsung just came out with a battery that uses like 32.15 ounces of silver in a battery. So they're using it, and as technology continues to advance, more and more silver is going to be consumed. And then you have the solar industry, right? There's 20 grams in each solar panel. So you start looking at the solar the solar panel installation around the world. It's exceeded estimates, supposed to grow 10x over the next like 3, 4, 5 years. A tremendous amount of silver is going to be consumed. So the silver mines, they produce about 800 million ounces per year. One of the things about silver, it's mainly a byproduct. So the majority of the silver productions comes from copper mines like TGH and Polska, which operates as big copper mines. So they're producing billions of pounds of copper, and then they produces millions and millions of ounces of silver, but it's just a small piece of their revenue. That's where the majority of silver production comes from. But again, it's only 800 million ounces silver. Demand has been over 1 billion ounces for the past 3 years. So silver has been in a net supply demand deficit for like 3 years of about 100 mil to 200 million ounces. There's a couple new mines, moving forward right now that are probably going to be in production, but they're going to produce like 4 mil, 5 mil ounces a year. And just the silver demand is overwhelming, silver supply right now. So I'm positive regarding silver. But the thing about silver is like if you look at a correlation with gold, it's obviously it's very correlated with gold. It basically follows gold, but silver goes on massive tears. Like when gold really gets rocking, silver will explode higher. But the thing about this is a lot of people invest for this. A lot of people invest. Silver's going to 50, silver's going to 100. It probably will. But every major spike in silver, 1980 with the Hunt brothers, the last spike, the silver squeeze in what, 2020, it only lasts like 2 days. So like your timing can't be on vacation. You got to be on. Yeah, you got to be on it. So that that happens maybe 1% of the occurrences. I invest for the other 99% of occurrences when silver's in a normal market. So yeah, I believe silver is going to be going higher. It, like I heard you talking before, 32, 34, and it's just the cup and handle. It's breaking higher. When it breaks, it's just going to go, But the thing about silver this year, it's been relatively, stable, like 30, 31, 32. And then the companies that produce the silver, they sell it on a daily basis. So you need that average silver price over a quarter to stay high, and it has been. So that a few of the silver miners, they're generating, good solid profits here, at $30 silver. Yes, silver is going to go higher. One other thing regarding silver, silver miners are less profitable than gold miners. Because they're mostly producing concentrate, and they sell the concentrate, and they only receive 85% of the metal's value. So that's why a lot of silver producers have moved toward gold over the past few years, because if you just look at the margin between the gold and silver price versus all-in sustaining cost, I think it's like 45% in gold right now, and in silver it's probably like 30%. So like I'm a micro guy. Like it's fun to talk about the macro, but who really knows? Like we all have our beliefs about what's going to happen to gold, what's going to happen to silver. But I'm a micro guy. I measure the profits. I measure the free cash flow, because one of the things where people get confused, they're like, silver's going higher. Or you look at the price of gold and you look at the chart of the GDX, right? And gold's going higher, GDX is going lower. People are like, look at that gap. That's an opportunity. And I'm like, not really, because gold is no one's liability. It's an unencumbered asset. It has no cost or expense, maybe a little bit, a few basis points. But stocks, what a stock is, a stock measures the lifetime profits of the asset bakes, right? So, and then regarding the company and regarding the stock, you've got revenue from gold and silver, but you have all your expenses. You got management, you got exploration, you got this, you got that. And the only factor that drives gold and silver stocks higher is increasing economics on a per share basis. So, and the problem with the gold and silver industry is when inflation goes higher and it pushes gold and silver higher, their costs follow, so they're all-in sustaining margins are at like 45%, which is where they were like 15, 20 years ago. And gold moved from $500 to $2,700 an ounce now. So you need to find the miners that can increase economics on a per share basis to drive free cash flow higher. That's going to drive the stock price. And that's what I evaluate, and that's what I follow. And then if you need catalysts, you need to find individual opportunities within each company to show the valuation gap. The valuation, enterprise value, right? Market cap plus debt minus fees, versus, the lifetime free cash flow of the mine or mines or project in development. And you need to measure that. And I've been following the Lassonde curve very closely. The Lassonde curve, exploration up, it goes into a trough.
Yep.
And I invest in the troughs of the Lassonde curve, because there's one company right now. I can talk about 100 companies, but for example, Montage Gold. Montage Gold has an amazing asset in CDI, and it's fully financed. Wheaton just gave them $710 million to finance the whole construction. Trades for $500 million enterprise value. The NAV value of their project is worth $2.1 billion. So at first production, EV should match NAV, because EV's lifetime cash flow is even mine. So there's risk involved. There's gold price uncertainty over the next couple of years till 2027 when they come production. But right now, company trades for $500 million. It's worth $2.1 billion. So it rides up the Lassonde curve to first production, and then it goes down. So to be honest with you, like these stocks are going to do great when gold goes higher. But that is like the cherry on top, the whole ice cream sundae.
Yeah.
Like,
Have to have that.
exactly. And if you're dependent upon a rising gold price to make money, oh, it's not profitable now, but at $5,000 gold, it's like, no, 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 no. You need to find companies that are undervalued now, that have specific things going on that you can intrinsically measure to show the undervaluation on an EV free cash flow basis.
Yeah.
So that's what I specialize in.
Okay. What going into some of your metrics? So, like when you're looking at gold and you're looking at grams per ton.
Yeah.
Grams per ton. Kindergarten method. What's your cutoff above ground? What's your general cutoff below ground? I realize there's so many variables in there, but for gold and for silver.
Yeah. One of the things that I've discovered over my career, I'm friendly with Peter McGaw, the geologist. He's famous for discovering massive CRD deposits around the world, mostly silver. He discovered Mags Juanicipio in its first drill hole, and he's just a legend in the industry. He shared with me a paper in a journal that he wrote, and it was Archie's rule, and it's about Archie Bell, who was chief geologist for Noranda back in the day. He's a legend in the industry. But Archie's rule was a simple back of the envelope way for geologists to measure the value of a deposit, to figure out, is this going to be economic or is it not? Should we continue pursuing this? And what he found out was that, the project grade needs to be the NSR, the revenue from the mine, needs to be 2 times operating costs. And the only way you can do this is by increasing grade, because mining on a per ton basis is basically fixed costs, right? It's like 200 Silvercrest metals, for example. Their costs were $250 a ton over the last quarter. And if their costs were $250 a ton, you look at the average silver grade that it would take to cover that, to make enough revenue. And that silver grade was 250 grams per ton, right? On a gold basis, it's 3 grams per ton. Like, there's a lot of factors about open pit, underground, heat, bleach, processing. But, generally 250 grams a ton, 3 grams a ton for gold. This is underground deposits. And if you don't have a reserve grade, or you're not mining at over 250 grams per ton, you're not making any money.
Yeah.
And I follow a lot of smaller gold companies, a lot of smaller silver companies. They're mining at 200 grams a ton, 180 grams. They're not making money. They're losing money year after year, and they plug it by selling shares continuously. And then, so Silvercrest grade, it was like 600 grams per ton. So it's basically double their costs, which is what Archie's rule looks for. You need to find highest grade to basically produce revenue twice your cost. And it allowed Silvercrest Metals to pay down $40 million of debt, build 100 mil, put 100 mil profits in the bank over like 1 year. Like, it paid for everything. Yeah. And then Core Mining just came in and took it over. Yeah, we'll see how that goes. But you need to follow grade, because costs are fixed on on a basis, on a per tonnage basis. So grade is the only thing that drive the revenue higher, and that's one of the main factors that I follow.
Okay. So underground for gold, you're saying about, there's so many factors, but about 3 years. So about, okay. Open pit, what would you say?
I don't really gram per ton.
Okay.
Yeah.
Gram or so?
Yeah. Okay. Because the costs are a lot less.
Okay.
As bits that are underground.
And open pit for silver.
I do. That's a good question. There's a couple companies that I follow. Aya's got a big open pit at Silver Sand. They are, production, I don't know, 2027, 2028. That's going to be interesting to see. But the thing about gold is you can basically heap leach it, which reduces the cost. And one company, Rio, Rio 2. Bring that up. Alex Black. He founded Rio, and Rio was an amazing project with Shahindo and one of the other mines, and it got acquired. But it's basically a big open heat leach. You just pick up the ore, and you process it a little bit. You drop it on the heat leach, and it's probably $50 a ton on a heap leach versus $250 for underground mining. But their new project is called run of the mill ore, which means you dig it up, and then you place it over here. You don't have to process it. You don't have to do anything. It is the most economic way of mining ever. Their costs are, $20 a ton probably, and they're starting out at 20,000 tons per day.
Yeah.
They need to get more water in there and a whole growth and a whole stage approach. But there's basically no mill. There's minimal capex.
Yeah.
You got to build the heat bleach pads and stuff like that. But he's going to scale it just like he did with Rio, from 20 to 40 to 60 to 80,000 ton, like 4x. And the company, Rio's trading for, I don't,
44 cents American or something.
yeah, but as far as enterprise value, I think it's like 150 mil or 200 mil.
I was going to say 200 mil.
Yeah, all right.
Okay.
And then that's in the same thing on the Trosilo stock curve right there. And their asset Phoenix, I think it's got a NAV of, I don't know, 750 mil.
Yeah.
Right. And that's only at 20,000 tons per day.
Yeah.
Never mind 40 or 60 or 80. You get the stock train down here. You get the project work here, rides up the Lassonde curve. And even if gold goes, to 27, to 25, to 2,000, it's still extremely economic, and the NAV will come down a little bit, but the stock is still undervalued. So yeah, it's going to continue higher.
Yeah, I like that one a lot. I've been following that one for 3 years.
Yeah.
And so we went through the whole chinchilla scare. Yeah. And then finally we're out. Finally they're doing good.
In Canada, they call it birds and bees. Down there, they call it chinchillas and llamas.
Llamas, yeah. Yeah, very exciting project. Yeah, I think that one will do really, really well. Time to sell. But the biggest concern with that one is the water. They got a truck in the water.
Yeah.
But maybe by then they'll sold the project.
They'll figure it out, whether it's a pipeline or they'll be able to put money in the bank in order to. There's a new well. They bought a property a few kilometers away a couple of years ago that could provide them with water. I don't know, but bottom line, like, everything's about money.
Yeah.
Right. Just, you get older, it sucks. It's, all about profits, put money in your pocket. So if a mine is extremely economic and extremely profitable, they're going to figure it out.
They'll figure out a way to do it. Okay. So what you focus on is not necessarily Agnico Eagle. You focus more on, like what we talked about, Rio2. So you focus on the small ones, right? The ones that have a lot of leverage.
Yeah.
Tell us about your website and what you do.
Yeah, well, let me say a couple things about the majors. So, the Lassonde curve and then the majors, a mine is worth the most on day one of production.
Yeah.
Right? Because it's got all of its NAV value right there, and you start mining, your reserves start dropping. Yeah, you might get exploration to bump it back up, but in general, reserves start dropping, and then you lose 1 year of mine life, and you go to year 2, year 3, and it gets shorter and shorter. So there's less and less value. That's the thing.
Yeah.
As time goes by, it's harder and harder for the majors to add value. It's like trying to stand on a treadmill. The treadmill's constantly moving, and if you ain't moving forward, like, you're gonna fall off. And if you move forward, you're standing still. So, like, the best the majors can do is kind of like stand still on that constantly revolving depletion reserves. And then the way the financial community, it's like, don't hate the player, hate the game. This is just the way that they evaluate projects. They use NAV, they use free cash flow, they use DCF. In miners, at the end of year 10, they're worth 0, right? You got a depleted asset, and it probably represents a liability. So after 10 years, you take the profits, it's discounted. That ratio is 7.7 multiplier of $1 discounted by 5% over 10 years. That's $7.7. The miners right now traded like 6.4. They trade below terminal value NAV. And the tech stocks, the deal with all these growth companies, the tech stocks, in year 11, the miners get no value for any of their future production. But tech stocks, what they do is they take the year 10 free cash flow, they put a multiplier on it. It's got a 3% growth rate. So you divide that last period cash flow by the 3%, and then you get like more value than the whole initial 10 years on the work. So the multiplier is like 20x or 30x. That's why miners trade the way they do, and that's why tech stocks trade the way they do. It's all connected to the map. It's all connected to the numbers.
Yeah.
And I can't change the game. I can follow the rules.
Yeah.
But yeah. So Golden Portfolio, I just started it last year. We did great. My GP IV product was up 140% with companies that, are in the trough of Lassonde curve. Some of the companies I have here today with me, Longcore Gold, you know that one?
I do.
CEO John Barker. It's in the DRC. Yeah, DRC is not a great region, but Barrick has been operating Commodities there for 15 years with no problems at all.
Idaho.
Yeah, Ivanhoe. And those are some of the biggest, most profitable mines in the world. So this company, Longcore, trades for 50 mil market cap. Their project is worth like close to $2 billion.
Wow.
It's trading at a 97% discount to fair value, representing 30x upside deep in the trough of the Lassonde curve.
Wow.
So yeah, and the grade is like 2.5 grams a ton, which is outrageous for an open pit.
Yeah.
It's extremely economic. It's an underknown story. They haven't done any marketing. They finally came out here with me just to start telling their story. It's going to be a tier 1 asset. It's going to be one of the best gold mines in the world, and you can buy it at a 97% discount. And then the other one is, I like finding like hidden gems, you know what I mean, with financial acumen. And I love royalties. Royalties are the best way to
Those are fun, aren't they? Yeah.
I'm like, listen, what if you just invested in royalties since 2007 when Franco was rolled out? You would have made 13,000%, like 30% a year, like better than Buffett, better than Lynch, better than anyone. Why? Because royalties are fixed costs. Their cost never changes. Gold goes up. They have free exploration upside because they pay based off that 10-year NAV. Anything that comes after, you're getting for free. Pierre Lassonde paid $2 million for Gold Strike after fighting in the Reno Gazette, and it's returned like $1 billion, $1 billion, and it's still worth like another 500 mil. It's ridiculous economics. You only need 3 or 4 people to operate them. You don't have to pay 200, 300 miners. And all the smaller fish always get eaten by the big fish. There's been about 10 or 15 acquisitions within the royalty space over the past 15 years. And any smaller royalty with a good asset, they all get snatched up.
Yes.
And I've got a few in my other portfolio, the GP, the golden portfolio, of these smaller royalties that are going to get acquired over the next few years, because one of them was a 1% NSR in Silicon Merlin, which is the largest gold project in the world, owned by AngloGold. But then Origin, love erratic, interviewed better, recently. That is extremely undervalued. It's going to be worth $6 million a year at a royalty multiples. That's 120 mil multiple, and it's represented opportunity. But the one I want to talk about was Globex Mining. Globex, it's run by Jack Stock. And he's an older guy, has been in the industry. He built this whole portfolio of like 250 assets, and they're all coming close to production with all royalties attached to it. And then he's cheap. He prefers that I call him frugal, but he's cheap. He doesn't spend money. He's got $30 million of cash in the bag. It's profitable every quarter. They generate $5 million of free cash flow every year. The management salaries are only $300,000 that he pays himself. They have Ironwood, which is extremely high grade, or that they might produce themselves. They own a 1% NSR in Mont Sorcier, one of the largest iron ore projects upcoming. So the royalties, they have got 250, 300 properties. Yeah. All they need are 1 or 2 to get lucky. You know what I mean? Whereas the miners, if they get a mine and the mine goes bad, they're in trouble. Yeah. Whereas the royalties, you're diversified. It's the best way to play it. So yeah, Longcore Gold and Globex Mining, actually.
Okay, those are your 2 favorites that you really.
They're here with me today.
Okay. Going back to Origin, have you heard any news on Altius or any of the arbitration that's going on there?
Altius won some of it. The arbitration wasn't about the original claim. It was about all the areas around it. Yeah. So they've still got their 2% NSR on the existing claim, and they partially won the lawsuit where they were awarded additional claims from that area, but it's still pending over the larger area.
They haven't picked it up with pending.
Yeah, no. But yeah, I think it's holding the project up. I mean, it's only a 1% NSR and a 2% NSR. But I haven't heard much from AngloGold that owns the project. But man, when they freaking found that deposit just 2 years ago, they went from 0 to 13 million ounces of gold. It's going to produce 1.6 million ounces in year 2 of production. It's going to be one of the largest gold mines in the world. It's in Nevada, and it's a really interesting story. You know how they found that deposit?
No.
Using satellite data. There's a thing called Avarice. It's a NASA website, and it's all satellite images, and it's publicly available, AVERIS. So the geologist uses AVERIS data to evaluate potential deposits. And I don't know exactly what he looks for, but that's how he identified Silicon Merlets. And the beauty of the royalty industry, Origin spent $100,000 to buy the rights to this, Silicon Merlin project. They found it. They're going to get 100,000 ounces of gold.
Yeah.
But sorry, no, they're
Fucking hell.
so like I'm in the newsletter industry, and I do good research, but it's a lot of it's marketing, and it's like all the marketing guys are like that you see the promotions out there. They're like, here, learn how to buy an ounce of gold for $20. Learn how to buy. All right, I got a better one. Just like 6-minute ads, make it 3-minute ads. Yeah, learn how to buy an ounce of gold for $1. Yeah, Origin.
That's awesome. That's all. Yeah, I started following them started buying them when they were. I think the deposit was 7 million ounces.
Yeah.
And pretty in short order, it went to 13.1 or whatever it is now, and it's growing by the minute. So
like Origin's gonna get bought out. Because all the majors want assets like that. They pay up for them, and all the small guys get bought out.
Yeah. That was awesome. Right on. Okay, your website.
Oh yeah, Golden Portfolio. You go there. I sign up for my free Secrets of a Mining Analyst Masterclass to learn more about my 3 products and my outlook and my view on how I value gold stocks and where the gold prices go. And so, goldenportfolio.com.
Goldenportfolio.com. There'll be a link down in the show notes. Thank you very much for coming on the show. This was a real pleasure.
Yep. Awesome.
And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.